Hey everyone, welcome back to Corporate Decoder, the place where we break down the biggest corporate secrets so you can understand what is really going on under the hood, especially when it comes to those really dense filings that make your eyes glaze over. Today we're diving deep into Baxter International Inc.'s annual report, the 10K, and trust me, this one's got some twists, turns, and a few eyebrow-raising numbers we need to decode. So picture this: a massive company, Baxter, that makes crucial medical products, decides to sell off a big chunk of its business, then does some major debt shuffling, and all the while, their bottom line looks, well, let's just say it tells a story. We're talking billion-dollar deals. Massive debt repayments and some serious swings in profitability. Stick around, because we're about to unpack it all. And hey, if you appreciate getting straight insights from corporate documents like this, make sure you are subscribed and ring that notification bell. We also have a growing community Discord server linked in the description below, so come hang out and discuss these findings with other corporate decoding enthusiasts. Alright, let's get straight to the heart of it. Baxter has been making some big strategic moves. One of the most significant was selling off their kidney care business in January of 2025 for a cool $3.8 billion in cash. Now, this was a pretty big deal, and while it brought in a lot of cash, it also meant Baxter became that much smaller and less diversified. They definitely used a good chunk of that money to pay down some serious debt, which is a smart move when you are trying to get your financial house in order. But here is the catch: the report mentions they're still dealing with dyssynergies after this sale, which basically means leftover costs or problems from splitting the business off. They're actively restructuring to make sure their remaining business can stand on its own 2 feet. On top of that sale, Baxter rolled out a new way of running the company in late 2023. Think of it as simplifying things, making manufacturing and the supply chain work better with sales. This led to them organizing into 3 main parts: medical products and therapies, healthcare systems and technologies, and pharmaceuticals. This restructuring is meant to make them more agile and responsive, but overhauls like these always come with their own set of risks and challenges, which they've detailed in the various risk factors. Before even getting to the kidney care sale back in September of 2023, they also unloaded their Biopharma Solutions business for nearly $4 billion. That brought in a lot of cash too, which they also used to pay down debt. So you can see a theme here: selling off parts of the business to manage their massive debt load. This is a pretty common strategy for companies trying to streamline and improve their financial health, but it does mean they're focusing on a narrower set of businesses. Now, let's talk about the money. As of the end of 2025, Baxter had about $9.5 billion in debt. They've been paying down a lot, especially with the proceeds from these big sales. But with all that debt, a huge chunk of their cash flow goes just to pay the interest and the loan payments. This means less money is available for things like research and development to create new products, or for capital expenditures to upgrade their factories. They're also committed to reaching a net leverage target, which essentially means getting their debt down to a more manageable level compared to their earnings, and they want to do that by the end of 2026. This focus on debt reduction means they recently cut their quarterly dividend significantly to just a penny per share, and they're not buying back any stock right now. They're really prioritizing getting that debt under control. Baxter operates in a super competitive space. They're up against all sorts of international and domestic companies, and the focus is always on who can offer the best price, the best product performance, and the most reliable supply. The report highlights that the healthcare industry is always looking for ways to be more cost effective, and this is leading to consolidation among their customers and even among their competitors. This means Baxter is facing constant pressure to either lower prices or find ways to make their products more appealing, which can really squeeze their profits. They've even seen demand levels in some of their key product lines get reset, partly due to changes in clinical practices after a hurricane, and partly due to tougher competition. It sounds like they're struggling to keep up with the pace of innovation and changing customer needs, which is a major risk. The past few years have been a real challenge for Baxter's supply chain. They've faced production delays, shortages of raw materials like resins and electronic parts, and higher costs for just about everything, from transportation to labor. This was made worse by things like hurricanes, the ongoing effects of global pandemics, and even geopolitical events. They admit they are more susceptible to freight cost increases and other supply chain problems than some of their peers. And it is not getting easier. They expect these challenges to continue, which could mean they won't be able to meet customer demand, directly impacting their sales. Now, something increasingly important for all companies is cybersecurity. Baxter relies heavily on its information technology systems, and they're also dealing with a massive amount of sensitive patient and employee data. They've already had cyber incidents in the past and are very aware of the risks from sophisticated attacks. including those using artificial intelligence. The big concern here is that a breach could not only disrupt their operations, but also expose private information, leading to huge financial penalties, reputational damage, and even legal battles. They're investing in defenses, but the threat landscape is constantly evolving, making it a never-ending challenge. Plus, with all the remote work arrangements and integrating new companies, the attack surface is only getting wider. Let's look at the financials. The profit and loss statement shows a net loss attributable to Baxter stockholders of $957 million in 2025. Ouch, a big reason for this is a massive $485 million goodwill impairment charge for their frontline care business. They also had a $425 million impairment charge in 2024 for the same business. Goodwill impairment happens when a company realizes that a business it acquired is not worth as much as it originally paid for it. Essentially, they overpaid and are now writing down that overpayment on their books. In simpler terms, they paid way too much for parts of this business, and now the value has dropped significantly. They also took a $290 million hit from an intangible asset impairment, specifically for the Welch Allyn trade name, meaning that brand name is no longer as valuable to them as they thought. These are huge write-offs that directly impact their reported profit. Looking at the balance sheet as of the 31st of December 2025, we see a total asset value of just over $20 billion, which is down from nearly $26 billion in 2024. This drop makes sense given they sold off major parts of their business. On the flip side, their total liabilities also decreased, from about $18.8 billion in 2024 to just under $14 billion in 2025, largely thanks to paying down debt. This improvement in their debt situation is a positive, but with nearly $9.5 billion in long-term debt still outstanding, they've got a long way to go to feel truly financially free. Now let's talk about revenue. Their total net sales hit $11.2 billion in 2025, up about 6% from 2024. That sounds good, but we need to look closer. Their sales from continuing operations, meaning the core business they're keeping, actually took a hit, ending at a loss of $900 million. The big reason for this is those special items we mentioned earlier. The impairments and other restructuring costs really hammered their profitability. The company is trying to put a positive spin on the sales increase, but when you strip away the special items, the underlying business is clearly struggling. This report shows that Baxter is still heavily burdened by a lot of debt. Even with the money from selling off business units, they have billions in outstanding loans. This means they have to spend a huge amount just servicing that debt, money that could otherwise be used for innovation and growing the company. They're aiming to get their debt levels down to about 3 times their earnings by the end of 2026, which is a critical target. Failure to hit that could mean credit rating downgrades, making it even more expensive to borrow money. One area that always catches my eye in these reports is the pension and post-retirement benefit obligations. Baxter has a significant pension liability, with their benefit obligations outstripping their plan assets by quite a bit. For their pension plans, the shortfall is around $471 million, and for other post-retirement benefits, it is another $139 million. This means they owe a lot more in future benefits to retirees than they currently have set aside. While it is not an immediate crisis, it is a long-term financial commitment that adds to their overall financial picture. Baxter states that their management believes their internal controls over financial reporting are effective. This is important because it means they have systems in place to ensure their financial statements are accurate and reliable. They're subject to audits by PricewaterhouseCoopers LLP, who also agree that the financial statements are fairly presented. This provides a level of confidence in the numbers we're looking at. This one is interesting. Baxter wrote down the value of the Welch Allyn trade name by $290 million. This means they decided the brand, which they had previously thought would retain its value indefinitely, is now worth significantly less. The reason given is lower forecasted revenues and margins for the products associated with that brand. It is a stark reminder that even valuable brand names can lose value if the underlying business performance falters. So, what is the big picture here for Baxter International Incorporated? They've made some bold moves, selling off major businesses to tackle a mountain of debt. This has trimmed down the company, but it has also created new challenges like synergies and a narrower focus. The big win is their debt reduction efforts, which are crucial for long-term stability. However, their core businesses are facing intense competition, pressure on pricing, and supply chain disruptions. The significant goodwill and intangible asset impairments, particularly on the frontline care business and the Welch Allyn trade name, signal that they might have overpaid for some assets or their future performance expectations have diminished. The large pension deficit is also a long-term concern. While they're making strides in managing their debt, the underlying profitability of their ongoing operations looks shaky. Struggling with consistent growth and facing headwinds from market conditions and regulatory changes, the direction Baxter is heading seems to be a leaner, more focused company, heavily prioritizing debt reduction. The strengths are in their established product portfolio and global reach, but the weaknesses are clear in the profitability of their core operations and the sheer size of their debt. The biggest risks are continued competitive pressure, supply chain instability, and the potential for further impairments or restructuring charges if their improvement strategies don't fully pan out. The opportunities lie in successful integration of acquired businesses, continued innovation, and achieving those critical debt reduction targets. Overall, Baxter is in a transitional period, navigating significant structural changes and economic pressures. The sales of major divisions provided much needed liquidity to address debt, but the profitability of their remaining operations needs a serious boost. The path forward will depend heavily on their ability to innovate, control costs, and effectively manage their debt levels in a challenging market. Alright, that is our deep dive into Baxter's latest annual report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps the channel. And of course, subscribe for more corporate decoding. Don't forget to join our Discord community linked in the description to continue the conversation and connect with other corporate finance enthusiasts. Thanks for watching, and we'll see you in the next video.